Hello everyone, and welcome back to Building Business Plans and Structures. In our last class, we discussed how to create a marketing plan, which is crucial for attracting and retaining customers. Today, we will focus on cash projections, a vital component of your business plan that helps in managing your finances and ensuring your business remains financially healthy. So, what are cash projections? Cash projections, also known as cash flow projections, are estimates of the cash inflows and outflows of your business over a specific period. The primary purpose of cash projections is to ensure that your business has enough cash to meet its obligations and avoid liquidity problems. They help you plan for future financial needs and make informed business decisions. There are three types of cash flow: cash flow from operations, cash flow from investing, and cash flow from financing. First, cash flow from operations. This includes sales and other business-related cash flows. This number can be positive or negative depending on how well the business is performing. If it is a positive number, it means the business is profitable. Cash flow from investing. These include investments that are made for the well-being of the business. This includes things like ovens, trucks, or printers. Despite the name, this does not include stocks, bonds, or other cash equivalents. This will most likely be a negative number because you're spending money to buy these ovens, trucks, or printers. Finally, cash flow from financing. This is the cash gained from financing activities. This includes things like paid-in capital, long-term debt, and paying dividends or distributions. Cash coming in will be a positive number, while paying off debt will be a negative number. A comprehensive cash projection typically includes the following components: cash inflows. This is money received from sales, investments, loans, etc. Cash outflows. Money spent on expenses such as salaries, rent, utilities, and supplies. Net cash flow. This is the difference between cash inflows and outflows, indicating whether you have a surplus or deficit. Opening cash balance. This is the amount of cash at the beginning of the period. And then the closing cash balance is the amount of cash at the end of the period after accounting for inflows and outflows. So what is benchmarking? Benchmarks are numbers that are used to determine potential growth for your business. For example, if you know that rent will increase by 10% each year, then we can safely predict future cash flows assuming that rent increases each year. Benchmarks use the previous balance sheets and income statements combined with owner input to produce cash flow projections. Essentially, assuming historical margins and market conditions are known, we can make predictions about future cash flows based on this historical data. You can use a service such as LivePlan to see benchmarks for similar companies in your industry. Here are some comparative metrics that are helpful to know about your business. I won't get too in-depth on each of the comparative metrics. However, if you plan on using a benchmarking service such as LivePlan, it will be important for you to know these numbers so you can compare them against similar businesses. Incorporating accurate cash projections into your business plan is crucial for financial planning and management. For example, if your projections indicate a potential cash shortfall, you can plan ahead to secure additional funding or reduce expenses. Imagine that, for the cookie business, there is a shortage of eggs, which doubles the cost of them. As eggs are necessary for baking cookies, the business will have to work to reduce other costs or increase the selling price of the cookies to achieve normal cash flows and not lose any profit. Before we wrap up, let's address some common questions about cash projections. How often should cash projections be updated? Ideally, you should review and update your cash projections monthly or whenever there are significant changes in your business's operations. What are some common pitfalls to avoid when creating cash projections? Avoid overly optimistic sales forecasts, underestimating expenses, and ignoring seasonal variations in cash flow. To conclude, we've covered the essentials of creating cash projections, including their components, and the steps to develop them. In our next class, we will delve into management team and operational plan, another critical element in your business plan. Until then, start working on your cash projections using the framework we've discussed today. Thank you for joining me, and I look forward to our next session together.